Listen to one number, 106,862. That is not a stock price. That is not a company's market cap. That is the World Uncertainty Index reading being recorded right now, in April 2026. This index tracks how frequently the word uncertainty appears across economic reports, central bank documents, and corporate earnings calls from 143 countries around the world. And right now, it is higher than it was during COVID, higher than the 2008 financial crisis, higher than the weeks after September 11th. Let that sink in. This number has surpassed every single peak from 2001, 2008, and 2020. And the majority of investors right now are making the exact same mistake that gets made in every major crisis. But today, I am going to show you what professional fund managers are actually doing inside their portfolios right now. The thing that news channels are not covering. The rotation that has already started, and the people who understand it will be ahead of it, and the people who do not will be watching it happen without knowing why. On February 28, 2026, something happened that almost nobody expected. The United States and Israel launched coordinated airstrikes on Iran. The Strait of Hormuz, that narrow passage through which 25% of the world's seaborne oil travels, was effectively closed. The International Energy Agency called it the greatest threat to global energy security in history. That is not a YouTube channel being dramatic. That is the IEA's official statement. And today, in April 2026, Brent crude is trading near $95 a barrel. It peaked at nearly $128 in March. The IEA's latest report says global oil supply dropped by 10.1 million barrels per day in March alone. In a single month, the largest monthly oil price surge ever recorded happened in March 2026. Now, on top of all of this, three other things are happening simultaneously. First, dollar weakness. The US dollar index is trading around 98 right now. In January 2025, it was above 109. That is roughly a 10% decline in about a year. The dollar's share of global reserves, which was 71% in 2001, is now around 57%, the lowest level in 31 years. Second, Federal Reserve paralysis. The Fed is holding rates right now. On one side, inflation has come back up because of the energy shock. On the other side, the economy is giving slowdown signals. The Fed cannot satisfy both of these constraints at the same time. That is the definition of being stuck. Third, the S&P 500 was roughly 6 to 7% down year-to-date in the first week of April. Volatility is elevated, but here is what you need to understand. The index number is giving you the wrong picture, because underneath the surface, money is moving from one place to another. And where it is going, that is the secret we are going to break down today. First, understand why this situation is fundamentally different from 2008 or 2020, because understanding this difference is everything. When the market goes through a normal downturn, it is a valuation correction. Earnings estimates come down, investors panic. Then earnings stabilize, confidence comes back, and the market recovers. The cycle repeats. This time is different. This is a structural repricing. And in a structural repricing, not all companies recover at the same pace or to the same degree. The companies whose valuations assumed a world where oil was cheap, global supply chains were smooth, the dollar was strong, inflation was low, and rates were near zero. Those companies are now operating in a fundamentally different environment. Their outlook has genuinely changed. And the companies that are structurally positioned for this new environment, domestic energy, defense, gold, consumer companies with pricing power, those companies will go up not just because of sentiment, but because their earnings will genuinely improve. This distinction is practical, not academic. Because if you are sitting in an index fund thinking the market will recover, you are the investor who historically in this type of cycle gets nominal gains and real losses. Meanwhile, the people who understand sector rotation are collecting the returns you are missing. Capital always follows earnings. Earnings follow structural conditions. Structural conditions are changing right now. That is all there is to it. Now understand the three phases of a crisis, because the right positioning in each phase is different. Phase 1, the shock. These are the initial days and weeks when fear dominates. Markets drop 5 to 10%. Gold and oil rise. Defense stocks jump. And retail investors make one of three mistakes. Mistake 1, they sell everything and move to cash, locking in losses and guaranteeing they miss the recovery. Mistake 2, they do nothing, while a portfolio built for the old world loses value in the new one. Mistake 3, they chase the spike. They buy gold when it is already trading at $4,800. They pile into energy stocks after they have already moved 40%. What do institutions do in this phase? They do not react to prices. They analyze what the structural implications of the event are for different sectors. They build their watch lists. Phase 2, repricing. This is the period that typically begins 3 to 6 weeks after the initial shock. The market shifts from simple questions to sophisticated ones. Not just, is this bad, but how long does it last? Which companies can pass through higher costs? What does this mean for inflation and Fed policy? We are in this phase right now, April 2026. And this is exactly the moment when this information is most valuable. Phase 3, rotation. This is where informed investors make significant money. Capital inflows into the structurally correct sectors can last quarters and years, not because of sentiment, because earnings in those sectors genuinely improve, while earnings in the wrong sectors genuinely deteriorate. Capital always follows earnings. Always. Now we get to what you actually came here for. Which sectors are structurally positioned right now, and why? Structural winner number 1, energy infrastructure. The obvious trade was buying oil producers when the Strait of Hormuz closed. That was the shock trade. The real trade is energy infrastructure. Pipelines, storage terminals, LNG processing facilities, refineries. Why? 2 reasons. First, these assets directly benefit from higher energy prices. When oil is at $95 or $110, the cash flows of these companies improve by design. Second, and this is the part most analysis misses, every major economy in the world has now realized the strategic imperative to invest in domestic energy infrastructure. According to the EIA, when the Strait closed, U.S. LNG export facilities were running at near peak capacity, exporting almost 18 billion cubic feet per day. That tells you how much demand exists for this infrastructure and how much will continue to exist. According to the IEA, even after flows through the Strait resume, which is being assumed for late 2026, supply chain bottlenecks and infrastructure damage will keep the market tight. This is not a story measured in quarters. This is a story measured in years. Pipeline companies, LNG export terminals, and domestic storage operators are fundamentally different from companies whose earnings depend purely on geopolitical outcomes. Structural winner number 2, defense. But the right kind of defense. The obvious spike in defense stocks has already happened. Some ETFs gained more than 50% in 2025. If you are chasing that spike right now, you are already late. So what is the real trade? The U.S. Congress has approved a $900.6 billion defense budget for fiscal year 2026. The Trump administration has proposed $1.5 trillion for fiscal year 2027. But the distribution of this money is fundamentally different from previous defense cycles. The priorities right now are AI-enabled platforms, cyber defense, drone technology, space-based intelligence, and missile defense systems. The large traditional defense companies that build heavy ships and planes are actually facing contract execution challenges and supply chain issues. The real opportunity is in the specialized companies building next-generation capabilities. Companies whose valuations do not yet reflect the earnings trajectory that a sustained multi-year defense spending cycle will create. One important data point. NATO countries have committed to spending 5% of GDP on core defense by 2035. Germany, the UK, Poland, all expanding. This is not just a US story. This is a global story. Structural winner number 3, gold miners. More powerful than bullion. Gold is currently near $4,804 per ounce. 1 year ago, it was roughly $3,400. That is a gain of $1,180 in 1 year, more than 40%. But here is what the majority of investors do not understand. Physical gold and gold miners are 2 different things, and in this environment, the case for miners is distinct. Think about how it works. A miner's revenue is determined by the gold price. Its costs, labor, equipment, energy, capital expenditure are largely fixed in the near term. When gold moves from $3,400 to $4,800, a 40% move, the miner's revenue increases by nearly 40%. Its costs stay roughly the same. The operating margin expansion is therefore dramatic. That is leverage. Historically, in sustained gold bull markets, miners outperform bullion because this inherent operating leverage kicks in. And what are the structural tailwinds for gold right now? Dollar weakness, confirmed. DXY near 98 versus a high of 109. Central bank buying. In January 2026 alone, global central banks net purchased 150 tons of gold, and gold's share of reserves surpassed U.S. Treasuries for the first time. De-dollarization. BRICS nations are increasing local currency settlement. Fed accommodation risk. Rates are on hold while the economy slows. All of these forces together create a gold bull case that is not just a fear trade. It is a structural shift. Structural winner number 4, consumer staples. Boring, but brilliant. This is the sector almost nobody talks about because it does not seem exciting. But in this specific environment, it has 2 characteristics that are extremely valuable. First, pricing power. When inflation raises costs, which is happening right now because of the energy shock, consumer staples companies can pass those costs through to consumers, because people do not stop buying food, cleaning products, and personal care items. That pricing power is something discretionary companies simply do not have. Second, earnings non-cyclicality. When GDP growth slows, which is what is being projected right now in a stagflationary scenario, consumer staples earnings do not fall proportionally. They are not cyclical. This is a rare category that can deliver positive real returns when both inflation and slow growth are working at the same time. Now let us talk about the sectors that are genuinely challenged in this environment. Structural loser number 1, consumer discretionary. Companies selling things people want but do not need, fashion, entertainment, non-essential gadgets, are facing serious fundamental pressure. When oil prices are high, when tariffs have raised prices, when consumer confidence is down, discretionary spending falls. And these companies' costs are also rising from the same inflation that is squeezing the consumer's budget. Revenue and margin are both being compressed at the same time. Structural loser number 2, airlines. Jet fuel is a massive proportion of an airline's operating costs. When oil is trading at $95 or above, and Citi's analysis shows a worst-case scenario of $130 by the third quarter. The airline industry's cost structure is under extreme stress. The revenue side is simultaneously under pressure. Business travel is cautious. Consumer spending is squeezed. That combination is earnings compression by definition. Structural loser number 3, high-growth technology. These are companies whose valuations depend on distant future earnings. When real yields, risk-free returns, are elevated, the present value of those future cash flows falls mathematically. The path to a growth tech recovery requires inflation expectations to fall and a credible Fed rate cut path to emerge. That path exists if the strait reopens and oil moderates. But if the conflict re-escalates and oil goes back to $130, that path does not exist. This bifurcation is what defines the current moment. You cannot complete this analysis without talking about the dollar. The DXY is near 98 right now. In January 2025, it was at 109. That is roughly a 10% decline. The dollar's share of global reserves is near 57%, a 31-year low. In January 2026 alone, global central banks net sold $48 billion in dollar reserves. When the dollar weakens, specific things happen. Gold rises in dollar terms. That is already happening. Oil becomes more expensive in dollar terms. U.S. multinationals whose revenues are earned in euros, yen, and yuan translate those earnings into more dollars. Their profits improve. Emerging markets with dollar-denominated debt see their burden decrease in local currency terms. If you are 100% in U.S. stocks, U.S. cash, and U.S. bonds, sustained dollar weakness is working against you in real terms, even if your nominal returns appear stable. Now, I want to be honest with you. Anyone who tells you they know exactly what is going to happen is wrong. There are 3 realistic scenarios right now. Scenario A, best case, the ceasefire holds this week and the strait gradually reopens. According to Citi analysts, Brent would average around $95 in the second quarter, then fall toward $80. Inflation expectations could come down. A Fed rate cut path becomes credible. In this scenario, energy infrastructure remains strong because the structural demand has not gone away. Growth technology positions potentially become attractive again. Scenario B, base case. The strait partially reopens, but does not return to full pre-conflict levels until late 2026. This is actually the EIA's official forecast, a peak of $115 per barrel in the second quarter, gradually falling to $88 by the fourth quarter. In this scenario, energy infrastructure, gold miners, and consumer staples all outperform. The dollar remains weak. Rotation continues. Scenario C, worst case. Iran has already threatened retaliation following the U.S. Navy ship seizure. Citi's worst case projects $130 oil through the third quarter. Gold moves toward $5,000 and beyond. Energy and defense accelerate further. Inflation rises. The Fed remains paralyzed. Smart money is not asking which scenario will happen. Smart money is asking how to structure a portfolio that can navigate a combination of these scenarios. Here are the 3 mistakes the majority of people are making right now. Mistake 1. Sitting in cash because of paralysis. The uncertainty is real, but cash does not protect you from inflation. When the dollar is weak and inflation is elevated, the purchasing power of your cash is silently eroding. That is not safety. That is slow erosion. Mistake 2. Sitting in an index fund and waiting. The S&P 500 is a headline number. Underneath that headline, sectors are performing very differently. In a stagflationary environment, index fund strategy historically delivers nominal gains but negative or flat real returns, because the wrong sectors drag down performance while the right sectors have already moved. Mistake 3. Chasing spikes after the shock. Gold is already near $4,800. Defense stocks have already moved 40 to 50%. If you are jumping into these obvious trades right now simply because they are in the news, you are repeating the retail investor behavior that gets documented in every crisis. What is the right move? Understanding the structural case. Following the earnings trajectory. Positioning in sectors whose fundamentals will genuinely improve in this environment. Energy infrastructure, quality gold miners, consumer staples, and selective defense. Before the rotation becomes obvious and before mainstream media has covered the complete story. That World Uncertainty Index reading, 106,862, is not just a number. It is a measure of the range of outcomes that professional forecasters cannot confidently model right now. But uncertainty is not a random event. There are patterns, there are money flows, there are earnings trajectories, and those patterns can be understood. The scenario that is actually unthinkable to the majority of investors is not a crash. A crash is thinkable. Everyone is discussing it. The truly unthinkable scenario is this: the headline index grinds sideways or modestly higher for years, while underneath it the sectors positioned for the new structural environment deliver exceptional returns, and the sectors built for the old environment deliver sustained losses. That is the stagflationary equity scenario. It has happened before, in the 1970s, and the investors who understood sector rotation in that decade captured extraordinary returns. The index holders were not there to collect them. You are in the repricing phase right now. The rotation is beginning. If this analysis was useful, subscribe to the channel. In the next video, I am going to go deeper into specific companies and ETFs inside these sectors, the exact instruments that institutional research is putting on its watch list right now.